Gold is falling at the very moment most people thought it had every reason to rise. That is not a small mistake. That is the kind of mistake that empties accounts. When fear gets bigger and gold goes down anyway, I pay attention because that is usually when the market is telling me something deeper than the headline. If you like hearing the part of the market story that gets lost under the noise, stay close to me here because this is one of those moments when surface level investors get trapped and patient investors get sharper. I have watched gold long enough to know that people almost always turn it into a cartoon. They think gold goes up when the world looks dangerous and goes down when the world feels calm. That story is clean, easy, and emotionally satisfying. It is also incomplete enough to hurt you. Gold is not just a fear asset. Gold is a pricing machine tied to money, rates, liquidity, and human behavior under pressure. That is why this drop matters. On the surface, gold looks like it is failing its own job. Wars are active. Inflation fears are alive again. Governments are drowning in debt. Trust in institutions is thinner than most people want to admit. And yet gold rolled over hard after reaching a record near $5,594 an ounce on January 29th. By early March, I was watching it swing violently. On March 5th, it briefly pushed above 5,400, then fell back near 5,076 in the same session. By March 20th, it had dropped to around 4,564. By April 13th, it was still down around 4,735, and it had fallen more than 10% since the war shock that began on February 28th. That is not noise. That is a message. Most people heard that message and answered with the wrong idea. They said the fear trade was over. They said maybe gold was overbought. They said maybe the safe haven story was fake. I think all of those answers missed the thing that actually matters. Gold is crashing because the market suddenly had to respect the price of money again. I want to say that plainly because this is where people get lost. Gold does not pay interest. It just sits there. That is not an insult. That is simply the truth. So when I can suddenly get a better real return elsewhere, meaning a better return after inflation, gold has to fight harder for my attention. That phrase, real return, scares people more than it should. It just means how much I earn after inflation eats its share. If a bond pays me 5% and inflation is 3%, my real return is roughly 2%. That 2% matters because it tells me whether holding cash-like assets is rewarding or punishing me. Gold competes with that number all the time. One of the clearest studies I have seen found that over the last 2 decades, a 1 percentage point rise in 10-year real yields has often lined up with about an 18% drop in the inflation-adjusted gold price. I do not treat that like a law of nature, but I respect it because it shows me the direction of force. So when I saw oil jump and inflation fears return, I did not just see a reason for gold to rise. I also saw something else. I saw the market start to fear that central banks would have less room to cut rates. I saw higher inflation change the odds for easier money. And once that happened, the same fear that looked bullish for gold started becoming bearish for gold. That is the contradiction most investors missed. They saw war and assumed safe haven. I saw war, higher oil, stickier inflation, fewer rate cuts, a firmer dollar, and higher yields. In other words, I saw gold being squeezed by the exact thing most people forgot to check. They looked at fear. I looked at the cost of money. If that idea is already changing how you see risk, keep following my work because these turning points are where the market stops rewarding simple stories and starts rewarding people who can follow cause and effect all the way down. Let me slow that chain down because once I saw it clearly, the whole move made sense. A geopolitical shock pushed oil higher. Higher oil made investors worry that inflation would stay hotter for longer. Hotter inflation made rate cuts look less likely. Fewer cuts pushed treasury yields and the dollar higher. And higher yields and a stronger dollar put pressure on gold. That stronger dollar matters more than many people think. Gold is priced in dollars. So when the dollar rises, gold becomes more expensive for buyers using other currencies. A buyer in Europe, India, or Japan may still want gold, but the currency move makes the price feel heavier. That alone can reduce demand at the margin, and markets are set at the margin. Then comes the second layer, and this layer is even more important. Gold was not just being hurt by changing rate expectations, it was also being sold because it was one of the few things people still had profits in. When markets get stressed, investors often do not sell what they hate. They sell what they can. I have seen that pattern too many times to count. In a real squeeze, people do not act like textbook investors. They act like people who need cash now. They dump liquid winners to cover losses, reduce leverage, or calm down risk managers. Gold had been a winner. That made it useful as a source of cash. If I put it in everyday terms, it is like a family under pressure that sells the one item in the house that still holds value. They do not sell it because they stop believing in it. They sell it because it can be turned into money fast. That is exactly how markets behave under stress, just at a much larger scale and with colder faces. And the data fit that picture almost perfectly. In March, gold ETFs saw about $12 billion of outflows globally. That was the largest monthly outflow on record. North America alone saw roughly $13 billion leave gold funds in that month. That is not what a calm opinion change looks like. That is what pressure looks like. An ETF is just a fund that trades like a stock and holds the asset underneath. So when money rushes out of a gold ETF, it tells me a lot of investors want it out quickly and through the most liquid door. I do not need 1,000 theories when I can see real money leaving the room. Records like that are hard to ignore. There was also fast money making the drop worse. Commodity trading advisors, often called CTAs, are systematic funds that follow trends. They are not sitting around with a cup of coffee asking if gold still feels safe. Their models react to price and momentum. When the trend breaks, they can turn sellers fast and add fuel to the move. In March, some of those funds came into the month heavily long gold, meaning they were already leaning on the bullish side. When the market rolled over, that positioning worked like a trap door. Managed money on futures markets also cut exposure sharply during the sell-off. Once a crowded move starts unwinding, price can fall much faster than the news alone would justify. So no, I do not think gold was crashing because the world suddenly became healthy. I think gold was crashing because financial conditions tightened at the exact moment too many people were still staring at the fear story. They were looking at the smoke. The market was repricing the oxygen. Here is a question I would honestly ask myself if I owned gold mainly for protection. If the asset I call safety can fall right when panic rises, do I really understand what I own, or do I just like the story I tell myself about it? That question matters because the answer changes how I size risk. Gold is not broken when this happens. It is behaving like a modern financial asset. Over the last 20 years, gold has become far more liquid, far more fund-driven, and far more sensitive to rates than the old myth suggests. Today, the marginal price is often set by financial flows, not by jewelry demand or romantic ideas about shiny metal. That is one reason history helps me stay calm. In 2008, gold dropped hard during the worst part of the financial panic. Many people were shocked by that too. They thought a crisis should send gold straight up, but what happened instead was a liquidity crunch. Cash was king for a while, and gold got sold with other liquid assets. The drop in 2008 was severe, around 30% from peak to trough during the brutal phase of the crisis. But that was not the end of the story. After the forced selling passed and the world moved from panic into money printing and confidence loss, gold turned higher and eventually ran far above its old highs. The crash was real, so was the rebound. I remember that lesson because it changed how I think. In a crisis, there is a difference between what should happen in theory and what must happen in practice. In theory, gold is protection. In practice, the path can be ugly if people need dollars first. The first move is not always the final truth. I saw a smaller version of that lesson in 2013. Gold dropped about 15% around the time the Federal Reserve started talking about tapering. Tapering just meant slowing down its bond buying. Gold fell before rates had fully adjusted. The metal was signaling a shift in the money backdrop before many investors wanted to admit that shift was real. That is why I keep saying this move is not random. Gold is not falling because nobody cares about inflation, debt, or instability anymore. Gold is falling because the market decided that higher real yields and tighter money matter right now more than the long-term fear case. Time frame is everything in markets. What helps later can hurt first. There is another layer that many people also missed. They saw central banks buying gold over the last few years and assumed that would put a permanent floor under the market. I understand why that felt comforting. In 2024, central banks bought about 1,045 tons of gold. In 2025, they still bought about 863 tons. Those are huge numbers by historical standards. Poland added about 90 tons in 2024. India bought around 73. China reported another 44. Turkey was active too. These are not random purchases. They tell me governments still want an asset outside the direct promise of another government. That is a serious message about trust, reserves, and the shape of the future financial system. And central banks themselves have been saying the quiet part out loud. In a recent survey, 95% of central banks said they expected global official gold reserves to rise over the next year. 73% expected the share of US dollars in global reserves to be lower over the next 5 years. That is not a fringe view. That is institutional thinking. So if that is true, why did gold still get hit? Because slow strategic buying and fast financial selling are not the same thing. Central banks buy for reserve policy. ETFs and leveraged traders buy and sell for price, liquidity, and portfolio pressure. The strategic buyer may love the asset for 10 years. The fast money crowd can dump it in 10 minutes. That difference is everything. The long-term floor under gold can be real and still fail to stop a short-term air pocket. I have seen investors confuse support with timing over and over again. A structural buyer can help over a cycle. It does not mean I get instant protection on a Wednesday afternoon when yields spike and funds puke positions. March gave me a perfect example of that split. While North America was dumping gold ETFs in record size, Asia kept buying. Asian gold ETFs brought in about $2 billion in March and posted their strongest quarter on record. China led much of that flow, helped by weak local equities and a softer currency. India kept adding too. That split tells me something important. The West was trading gold like a position. Parts of Asia were buying gold like a reserve and savings asset. One side was reacting to changing rates and market stress. The other side was thinking about currency weakness, instability, and long-term store of value. Same metal, different motives, very different behavior. If I stop at that point, I can already see the deeper picture. Gold did not simply crash because investors got less scared. Gold crashed because the type of fear changed. It stopped being pure tail risk fear and became inflation and rates fear. That shift matters because gold can benefit from one kind of fear and suffer from the other, at least for a while. Have you built your portfolio for fear in general, or have you built it for the specific kind of fear the market is actually pricing right now? That one question can save a person years of confusion. I think that is where a lot of gold investors hurt themselves. They buy it with a vague belief that bad things equal higher prices, but markets are not that generous. They want precision. Is the bad thing deflationary or inflationary? Does it strengthen the dollar or weaken it? Does it make rate cuts more likely or less likely? Does it create long-term distrust or short-term demand for cash? When I ask those questions, this sell-off stops looking mysterious. A war shock lifted oil. Oil lifted inflation worries. Inflation worries lifted the expected path of rates. Higher rates lifted the dollar and real yields. Then liquidity stress and momentum traders magnified the move. I do not need a conspiracy when the mechanics are already strong enough, but I also do not want to become too short-term minded here because that would miss the other half of the system. The same world that is pressuring gold now is also building the long-term case for owning it. That is the part that makes this moment so interesting. The short-term driver and the long-term driver are fighting each other in public. On the short-term side, I see elevated yields, a firm dollar, and investors forced to respect cash again. On the long-term side, I see large deficits, rising geopolitical fragmentation, reserve diversification away from the dollar, and central banks still treating gold like strategic insurance. One side moves fast, the other side moves deep. I have learned not to confuse those two clocks. Fast markets can punish a correct long-term idea if the short-term money regime turns against it. That is why even good assets can crash, not because the thesis is dead, but because the path is ruled by who needs liquidity, who controls leverage, and what the current price of money happens to be. There is also a human reason this drop felt so painful. Gold had become too emotionally clean in people's minds. When an asset feels morally right, investors stop measuring it. They stop asking what is already priced in. They stop asking whether everyone already knows the bullish case. The story becomes a comfort blanket, and comfort is dangerous in markets. I try not to fall in love with any hedge. A hedge that I worship will eventually humble me. Gold is useful, but it is not magic. It can hedge slow loss of trust. It can hedge long cycles of money debasement, which just means my currency buys less over time. It can hedge policy errors, but it cannot promise me a smooth ride through every panic. So where do I think this goes next? I see three broad paths. The first path is simple. If yields stay high, the dollar stays firm, and central banks keep sounding tough on inflation, gold could remain under pressure or churn sideways with sharp, violent rallies that fail. In that path, the market keeps rewarding cash and punishing non-yielding assets. The second path is the one many gold bulls are waiting for. Growth starts to crack, financial stress spreads, and central banks move back toward cuts or softer policy. If that happens while deficits stay large and trust stays weak, gold can recover fast. In that world, the current sell-off may look more like a reset than a reversal. The third path is the trickiest, and it is the one I respect most because history has shown it to me before. We could get an even deeper liquidity scare first. That means gold might fall more before it rises because investors scramble for cash and sell anything liquid. Then, once policy turns and the dust settles, gold could become one of the strongest assets again. That third path is why I never use gold as an excuse to stop thinking. I do not assume that owning a protective asset removes the need for discipline. In fact, I think the opposite. The more defensive the asset, the more clearly I need to understand when it helps, when it lags, and why it behaves the way it does under stress. Would you still hold gold if I told you it might fail you first and protect you later? If the answer is no, then I would say the position is probably too large, too emotional, or too poorly understood. For me, that is the practical takeaway. I do not buy gold because I expect it to rise on every scary headline. I buy it when I buy it as part of a broader map. I want to know what rates are doing. I want to know what the dollar is doing. I want to know whether the market is starving for liquidity or starving for trust. I also separate forms of exposure. Physical gold, gold ETFs, and gold mining stocks are not the same thing. Physical gold is slow and stubborn. ETFs are liquid and can be dumped in a heartbeat. Miners add business risk on top of metal risk. If I mix those up, I end up thinking I own one thing when I really own three very different behaviors. For a younger investor, I would put it even more simply. Gold is not a growth engine. It does not build products, pay dividends, or expand like a business. It is more like financial insurance with a market price attached to it. Sometimes that insurance gets more valuable exactly when I want it. Sometimes the premium itself gets crushed before the payout logic returns. That is why I never want the gold part of my thinking to become mystical. I want it mechanical. If real yields rise, I know gold can suffer. If the dollar surges, I know gold can suffer. If investors need cash, I know gold can suffer even if the news sounds bullish. And that kind of clarity protects me better than blind conviction ever could. And once I have that clarity, I stop getting shaken by every sharp move. I can watch a 10% drop and ask a better question than, is gold broken? I can ask, what is the market paying me to learn right now? Usually the answer is about regime change. Usually the answer is about the hidden force beneath the headline. That is exactly what I think this crash is teaching. Gold is not collapsing because the old reasons to own it vanished. Gold is collapsing because the immediate money backdrop turned against it, and because too many investors forgot that a safe asset can still be sold when cash gets scarce and yields get attractive. The metal did not betray them. Their framework betrayed them. So when I step back and look at the full picture, I do not see a dead market. I see a market exposing lazy thinking. I see a market separating people who understand the system from people who only understand the slogan. I see a market reminding me that price moves are often driven less by belief than by pressure, incentives, and the brutal timing of liquidity. If I had to say the whole thing in one clean line, I would say it this way. Gold is crashing because investors were looking at danger while the market was looking at the price of money. And when the price of money rises fast enough, even the assets people call safe can get thrown overboard. That is the lesson I would carry forward now. Watch real yields, watch the dollar, watch liquidity, watch whether central banks are merely buying slowly while funds are selling fast. And above all, do not ask whether the headline sounds bullish for gold. Ask whether the money system underneath the headline is, because in markets, the asset is never just the asset. It is always the asset inside a system. And the people who survive longest are the ones who learn to read the system before they trust the story. Gold did not crash because fear disappeared. Gold crashed because cash suddenly mattered more than conviction.